It's pretty wild when you think about it, how just one single number released on a Friday morning can literally send a tidal wave across the entire global financial system. How it can kick off rallies in Tokyo, ignore total political chaos in Paris, and just completely defy historical trends from Mumbai all the way to New York. Well, that is exactly the story we are breaking down today. So let's get into it. It all kicked off with this one number, 22,000. Now, on its own, it means absolutely nothing. But on this particular Friday, this was the number that started a massive global chain reaction. So, what on earth is it? And here's the big reveal. This was a headline number from the U.S. jobs report for August. Now, all the experts, all the economists, they were expecting around 75,000 new jobs. The actual number, a measly 22,000. I mean, that is a huge miss, a complete whiff. And it acted like an economic shockwave. Okay, so your first thought is probably terrible news for the economy. Stocks should tank, right? Well, welcome to the bizarre, upside-down world of market logic. Because in this case, this absolutely disastrous report was seen as fantastic news. And it's all for one simple reason. It basically forced the U.S. Federal Reserve's hand, making an interest rate cut almost a dead certainty. And really, it wasn't just that one headline number. When you looked under the hood, the whole report was weak. The unemployment rate actually ticked up to 4.3%. And to add insult to injury, they went back and revised the numbers for the last 2 months downward by $21,000. So the picture was clear. The U.S. economy was slowing down, and the Fed was going to have to do something about it. So how sure were the markets? Well, this chart says it all. Traders immediately reacted. And the probability of the Fed cutting rates by 0.25%, that's 25 basis points in trader speak, well, it skyrocketed to an 88% chance. People weren't just expecting a cut, they were practically betting the farm on it. Some even started whispering about a bigger, 0.5% jumbo cut. And the result on Wall Street was instant. Instead of panic, we saw a party. U.S. markets rallied hard on the news. The tech-heavy Nasdaq didn't just go up. It surged to a brand new record high. And the S&P 500 and the Dow Jones, they were right there with it, closing with solid gains. Bad news was officially good news. But this story, it doesn't stop at the US border. Not even close. The idea that the world's most powerful central bank is about to make money cheaper to borrow, that has a massive global impact. So let's follow the ripple effect as it starts to spread across the planet. That wave of optimism hit Asia first. Markets all over the region opened higher. But just look at Japan. The Nikkei 225 index absolutely jumped, up a huge 1.9%. Now, that was a sign that this wasn't just about the Fed anymore. This global wave was about to crash into some major local news. And this quote right here, it nails the mechanics of what's happening. When the US Fed signals it's going to cut rates, it basically gives a green light to other central banks around the world. It gives them more freedom, what they call policy room, to maybe cut their own rates without having to worry about their currency getting all out of whack with the dollar. Okay, and this is where our story gets even more layered. Because this global trend, it didn't happen in a vacuum, right? In both Japan and France, some huge political news dropped at the exact same time. And it was fascinating to see how differently it all played out. So, over in Tokyo, that market rally that was already going strong suddenly got a massive shot of adrenaline. Out of nowhere, Prime Minister Shigeru Ishiba announced he was resigning, and investors immediately started betting that whoever came next would hit the gas on government spending to juice the economy. You can see the direct impact right here. The Japanese yen took a dive against the US dollar. Now, for Japan's giant export companies, the car makers, the electronics giants, a weaker yen is amazing news. It's like putting a for sale sign on all their products for the rest of the world. Now, let's jump over to Europe, because what happened there is such a great contrast. Well, Japan's political news was like pouring gasoline on the fire. France had a full-blown government collapse, and the market barely even blinked. I mean, think about this. The French prime minister was literally kicked out of office in a no-confidence vote. That's the kind of chaos that would normally freak investors out. And the reaction? French stocks actually went up almost a full percent. It shows you how powerful that global story, that bet on a Fed rescue, really was. It was strong enough to completely drown out major political instability. But wait, there was another major force working against this whole rally: the calendar itself. Because historically speaking, September is just a notoriously tough month for the stock market. This whole thing is so well known, it actually has a name: the September effect. For decades, for a bunch of reasons, maybe it's investors cashing out after summer vacation, maybe it's funds rebalancing their books, September has statistically been the worst month of the year for stocks. It's a real thing. And the numbers really don't lie. If you look back to 1928, the S&P 500 has lost, on average, about 1% in September, and it's only finished the month in the green less than 45% of the time. So that's a pretty serious historical headwind that this rally was flying into. So you have to wonder, with that gloomy history hanging over everything, was every single market around the world getting dragged down by this seasonal weakness? Well, not exactly. You just have to look at India. While its main index, the Nifty 50, only managed a small gain, hey, a gain is a gain, it was definitely bucking that global September trend. And its resilience was really coming from its own internal good news, especially a massive 3.3% surge in its auto sector. That was more than enough to make up for weakness in its big IT stocks. Okay, let's take a quick breath and put all these different pieces back together. We've seen a weak U.S. jobs number set off this incredible global chain reaction, which then collided with local politics and historical trends in some really fascinating ways. So, to recap the whole thing, you've got these four big forces all swirling around at the same time. It starts with that weak U.S. jobs report. That leads directly to number two, the expectation of a rate-cutting Federal Reserve. Then, that big global idea crashes into local surprises, like in Japan and France. And all of it is fighting against these powerful seasonal trends, like the September effect. And as we've seen from the US to Europe to Asia, in this giant tug of war, one of these forces is clearly winning right now. The entire market is making a huge bet on one idea, that central banks, led by the Fed, are riding to the rescue with cheaper money. But what's the one thing that could completely crash this party? What's the one piece of data that could completely derail this whole happy story for investors? Well, it all comes down to one word: inflation. And that really brings us to the bottom line. If the jobs report was last week's most important number, then the upcoming U.S. inflation report is now, without a doubt, the most important number in the world. Because if that number comes in too hot, it could completely shatter the market's hope for a rate cut. And that whole global ripple effect we just traced, it could reverse course in an instant.